Good morning all and welcome to another one of my videos. So I don't have euro dollar on watch today. I actually have dollar CAD and pound Kiwi. Euro dollar actually sold off. I didn't manage to get an entry on that. And if we just get euro dollar up, so you can see what happened on euro dollar there. If I just zoom in to the entry without breaking this down any further. So you can see that I was looking for that entry here. I was looking for price to come up to here because of how correctively it had fallen down, giving me a clue that this was the new area of value. As I said in my previous videos, I was looking for price to tap into that, push down and give a flag, fully aware that there was potentially enough volume in here for price to push to the downside without doing that. But you know, what do you do? Do you have a risk to reward tool on like this? Do you have a massive stop loss like that? You're seriously diminishing the risk to reward by doing something like that. So you have to have rules in trading. And as I said in my previous video, I believe it was yesterday's video, a lot of the time, the majority of the time, if you're looking for high quality setups, low risk setups, you will not, the entries that you're forecasting will not materialize. Okay. And a lot of people find that difficult. You know, they do the work at the weekend like I do. They forecast the entries, and then the majority, without meaning to sound negative, the majority will not shape up. That's just a fact. Okay. And you have to be, as a trader, you have to be okay with that. You have to be fine with that. And I've been doing this for long enough now. I believe that, you know, when it sells off, this moves like this used to cause me a lot of FOMO. It doesn't bother me at all because I stuck to my rules, and I know from my data that sticking to my rules is far more important than, you know, trying to catch something that didn't actually provide what you were looking for. So that is euro dollar. The volume was obviously built up in here, and obviously if these structures break, then there's going to be a lot of people that were trading within that bail out of their positions. So sometimes, as I've said previously, price finds liquidity from an area of value. Other times it builds liquidity. And the reason we say it builds liquidity is because when we get volume building up like this and it breaks out, as I say, many people were trading within here and they will bail out their positions. And of course, the banks stack their orders as well. So that is euro dollar. It is sold off. I will not be looking at this. Ordinarily, I would be looking for some kind of smaller flag, not a small flag, but because of the move down. But I would be looking for, hence why I had that ray line on there, something in that sort of 30-40% region, not so much the 50%. But you know, the reason I would not be looking for an entry at the moment is because if we just zoom out, this we have this structure here. We have this structure here, and we know that when we break the trend line, the lower trend line, which we have, if we just extend it out, we have a 90% chance of getting 90% of the way to the bottom of the structure, which is here. However, if you look, this is the daily chart after all. We have one serious and big inflection point there and another one there. This is an area where a lot of people, you don't need to be a genius to work out that this is an area where a lot of people would take profit, even if we are headed down to the base of this structure. So because of that, I would expect or anticipate price to consolidate sideways for a little while to allow people to take profit. And if we just drill down to the 15-minute chart, I'm not so concerned about this one, but certainly this one, it would make sense, which is why I've got the ray line there, for price to do something, you know, more in the region of, let's say that, before it pushes to the downside. And if you look at the time at the bottom of the screen, you know, that would be more of a Monday morning kind of position, okay? And that would also be, if we just take the Fibonacci tool, if we take it from there where the impulse started, that would be a correction which is 40%, which has pulled back 40% of the length of the impulse. So that would be what we call a healthy correction. So that would make more sense. But because we've, you know, kind of reacted off of that low, I wouldn't be surprised if price messes around for a while. So anyway, that is euro dollar. That sold off. It didn't provide me with the entry. So what am I looking for now? I ask myself. So dollar CAD is my preferred position. I did have a think about this. Pound Kiwi does look very nice, and I did toy with the idea of having this at the top of my list, but the reason that my pairs are ranked as they are, I will explain as we go through this video. So dollar CAD. Dollar CAD on the higher time frames, we have this completed 1, 2, 3 touch structure, and then price pushes to the upside. Okay, we do have a slight near miss here. That is a slight negative, especially when we moved up from this area in the form of a larger correction like that. As I've said previously, when we impulse up, we don't normally see a larger correction so early into the move. Certainly not this wide relative to the impulse up which has preceded it, but sometimes that happens. Okay, so two slight negatives there, but we have kind of negated them by way of the fact that we have since impulsed out of this structure aggressively and then formed quite a clear piece of structure here, about halfway into this potential impulse correction continuation, about halfway between this range, okay, where we also have another near miss. We have a slight near miss to here, okay, making it, a lot of these near misses don't get filled straight away. So we can have a near miss down here. Price then completes this structure, fills this near miss before pushing to the downside. Okay, so not all near misses get filled straight away. However, it's important to be aware that they're there. So we have the 1, 2, 3 touch structure, impulse correction, just looking for further continuation to the upside. And whether that breaks out of this structure and keeps going is another matter. But this is the weekly chart. So we have to bear that in mind. So what I can see here is that we have this liquidity point. We have a sharp hook point where price moved down sharply and then moved up sharply, giving me a clue that the sharp move down was caused by a lot of orders being placed in this area, and then the sharp move up was caused by a lot of these orders being filled and the stops and limit orders, etc., being below there. We then come back down. We have a near miss to that area. Okay, so it's no surprise to me that we moved up in a very non-progressive manner. We move up, we pull down sharply, we move up. This sharp move in itself tells me the price will likely find its way back down to there, which it did in the form of a 1, 2, 3 touch structure, this impulse correction continuation, giving me a clue that this impulse correction continuation has completed and that we could be looking for moves to the upside. However, sometimes we get a scoop double bottom. So price will scoop back down, tap out any limit and stop orders that are down here, and then we see the moves to the upside. Just looking at this now as a potential impulse correction continuation to take us to the start of this structure, this 90% rule, so the start of a piece of structure, and which just so happened to near miss this high here. Okay, so the fact that we have a near miss to that area means that there is likely still liquidity there, and that price will still, this is still an area of value which price is likely to find its way to. Another thing that stands out is we have this larger correction within this excuse me, within this impulse correction potential continuation, which just so happens to be sat halfway between this range from here to here. Okay, so that is typical of what we see, and we typically see expanding patterns as well. So where the trend lines, one trend line sloping down, or it's, the base is flat and one trend line is sloping up, that is what we call an expanding pattern. Okay, so I asked myself, am I well positioned then? Well, even on the daily, you can see we have this 1, 2, 3 touch structure for that, meaning that this is potentially a completed pattern or thereabouts before that move to the upside. So I would be well positioned. I then asked myself about the sequence. You can see we do have a high here, a near miss to that, and then we break that and then push down aggressively. But if this is a move to come to the downside, where are we coming to? We've kind of already filled all the orders that were down here, so I don't see the reason why the dollar at this moment in time would push to the downside, especially when the DXY looks very clear for a move to the upside. Okay, so the next thing I ask myself is the sequence. Is the sequence great? It's not the greatest sequence because the move up starts with a larger correction. Okay, that's not typical what we see. So that is a slight negative where the sequence is concerned. However, we then perform more of a typical sequence as we break out of here. Okay, so we see the impulse, tight correction, impulse into a slightly larger correction, into a slightly smaller one, into a slightly larger one, smaller ones, larger ones, and then that larger structure, which I was talking about halfway within a range. Another thing that stands out is that the base of this structure just so happens to be the base of this structure where there was also a sharp move. Okay, now when an area of value also happens to be the base of a very clear piece of structure, we even have a impulse correction continuation within that structure, completing the last leg. That is, it's highly likely that there are a lot of orders down there. Okay, another thing that stands out to me is that we have I mentioned this in yesterday's video. Uh, we have a lot of tight corrections. When we see these little tight corrections leading up to an area of value, that is usually indicative of people getting out of their positions. And what do we have here? We see this all the time. This kind of FOMO move where it gets close to there and doesn't quite reach it, and then the momentum comes in. And what we see in the majority of cases is it scoot back down. So there would have been some FOMO going on here, I'm sure. So with all of this considered, what I will be looking for today is the following. Just to tap down into that area, I need price for my entry requirements to be met. I need price to tap into that area, ideally just below, wash out all the orders, push back up, and then the flag. It would need to be a convincing impulse because this is a large structure, so I would need to see a convincing impulse. But if we get that followed by a tight flag, and this could easily be ready by the end of the day, I believe there's more news coming out in the United States this afternoon, which could be the catalyst, which causes price to either push down to this area and push back up, or if we are in this area already, impulse back up, and then we may see the flag up afterwards, which is typically just the big institutions, the big players stacking their orders. And if that occurs, then I will be able to manage this trade up to the kind of the start of this corrective channel for something in the region of 4 to 5%. I have an alert set just down there just to see it. We might trigger that even by the end of this video, but we shall see. But that's what I'm going to be looking for, folks. Nice and simple. And again, if we don't tap into this area, then I will not be looking to place a trade. But at the moment, it's looking fairly promising for an entry. Okay. Now, the reason I've got dollar CAD at the top of my watch list will become clear in a second. But let's talk about pound Kiwi. Right. So on the weekly chart, if I just auto scale this, we have this 1, 2, 3 touch structure which falls just shy. I've just cut through this volatility wick because, as I said, it looks like a bit of an outlier. And if you go to the line chart, that wick does not exist on the weekly chart. If you go to the daily chart, once again, line chart, that wick doesn't exist. So that gives me a clue that this is just a volatility spike, not actually price action, which is indicative of the sentiment of the market, which is a completely different thing. So we have this liquidity point here. We have this 1, 2, 3, which falls just shy of it. Okay, this is non-progressive price action. That's the thing that stands out to me about this. This is price has taken a long time, and it has got to this area in a very non-progressive way, suggesting that this is exhaustive price action, and that price will likely tap into this area, as I've said in previous videos, and then reject from it. We have this corrective move up. This was the other clue, corrective move up, and then we go into what we call an ending structure. So where there's no real structure, and then we get structure right at the end of a move, which just so happens to line up with a trend line and an area of liquidity. This is what we call an ending structure. And typically what we see, as I've said, at these standout areas of value, these weekly or daily highs, is we will see the brokers and these trading news platforms put out things in their little ticker feed, such as pound Kiwi at 3-year high. You can see this was 2020. What that does is when price gets to this area, this encourages, particularly when we break out of a piece of structure such as this encourages people to buy the highs, okay, because they fear it's going without them. They believe that what was previously resistance is now support. The brokers are doing their best to help this kind of behavior, this kind of trading behavior. And, then what we typically see is in a very aggressive move to the downside, price come crashing down. And this is what we call people being caught the wrong side of the market, which is you can see now has happened because we're now trading back below this liquidity point. I've said that in previous videos. Feel free to watch those videos. And So the next thing I ask myself is, am I well positioned? I am very well positioned for a move down to here to take out this low here, this 90% rule, the start of this piece of structure. So the next thing I ask myself is the sequence good? Let's have a look at the sequence. Okay, so we have these, if we can see this a bit more clearly on the 15-minute chart, on the 1 hour chart rather. So we have the impulse down tight correction into the slightly larger tight correction, into the larger, the tighter ones, into the larger one, into the tighter one. As I said previously, we get these tighter corrections on the break of these larger corrections because the volume has been built up in the larger corrections. So then price doesn't need to correct for as long for it to push to the downside. Okay. So the next thing I'm asking myself is where my area of value is, and is the entry, is this a low risk entry? Okay, so the sequence looks very, very good. We did start off with this slightly excessive large correction, but sometimes that happens, particularly on pairs such as pound kiwi, which can typically correct for longer. So the next thing I'm doing is I'm looking at so we have this impulse down here, and then you can see a slight tight correction out of that slightly larger tight correction, and then we have a sharp hook point. We have the sharp move up followed by a sharp move down, and that gave me a clue that this is where the liquidity was. And if we just measure from, given that this is a 15-minute chart, if we just measure from this impulse, whoops, that's the wrong tool. That's the price range tool. Let's try again. If we just measure from here down to the base of here, if we retrace to that area of value, that would be about a 45% retrace, which would be a healthy correction. This may not be ready by the end of the day, but if you look at what I forecasted, let's look at what I forecasted. I forecasted, where was I doing my forecast? About here. So I was forecasting here, and I was anticipating that near miss that I've talked about, where price gets close to the high and sells off. And if you actually look at this, so this is what I was forecasting. Obviously, we've pushed a bit lower. We got right to exactly where I thought price would reject, and we would get that near miss. Okay, and we scoot back up again, and we reject from exactly the same area. So it's not that I'm psychic or anything. I've just seen these things play out so many times that subconsciously, I probably unwittingly are getting more accurate with these near misses when I do my forecasts as to where they're actually likely to reject from, without even realizing that I'm doing it. But as I say, this is not about being right. This is just about um, trying to predict what the market will do. So what I'm actually looking for is, I'm looking for this expanding pattern. I'm still looking for the same thing. I'm looking for price to come up to that area, tap into that area. This is kind of what we would call a larger tight flag at the moment, and then I will be looking for a rejection in this area, and I may even be able to hide my stop loss above there for extra protection, which would be another positive. But if we pushed up to the area, then I would be looking for a risk entry within this larger tight flag. Okay. Now, one of the reasons I've put pound kiwi second on my list is my strike rate with dollar CAD is probably higher than with any other pair. That's one of the pairs that has yielded me the most returns. Dollar CAD, for some reason, I have a very high strike rate on. The other factor is, I'm happy with the positioning of both pairs. This is higher up in the run, but I'm happy with the positioning and the sequence of both pairs and the entry. But one of the reasons I've got dollar CAD at the top of my watch list is because my strike rate is higher with that than with other pairs. My strike rate, I think, with pound kiwi is probably lower than with a lot of pairs, though I'm still happy with the entry. The other reason is because it is Friday, right? And the spread on pound kiwi gets very, very high over the weekend. So the other factor in my thinking is that if I want to hold a position over the weekend on a dollar pair, the spread is always going to be pretty low. Okay. So I know that the spread is going to be low with dollar CAD if I want to hold my position over the weekend. Whereas with pound kiwi, I know that the spread is likely to be very, very high, which means that when price reopens on Sunday night here in the UK, when the markets open again, I know that the spread will likely go up very, very high, and I will likely be slipped out. So if both entries shape up at the same time, which I don't think is likely at this moment in time, but it could happen, then I will take dollar CAD for those reasons. I hope you've taken some value from this. I'm going to log off before TradingView kicks me off. Have a great weekend, and I will see you again in next week's video. Thanks for watching.